A lot of investors get into investments without digging into enough details about how the financing is structured. Today, we are going to bring on an expert lender to help you understand what to keep an eye on and how it can impact your bottom line.
Let's get ready to scale.
Hey guys, my name is Jeanette Friedrich, Director of Investor Relations here at Blue Lake Capital. Joining me today is Sean Kelly Rand. He is the managing partner at RD Advisors, which is a real estate investment firm focused on financing in select urban markets, including Boston and New York. Prior to that, he was the director at HQ Capital, a multifamily investment firm. And then before that, he was actually the senior VP at Monday Properties, as well as a previous director at Madison International Realty. And most interestingly enough, he actually began his career in global real estate at the Lehman Brothers. He has an MBA in finance and real estate from Columbia, as well as a bachelor's in economics and business from Boston University. And he's joining us today from his New York office. So, Sean, welcome to the show.
Thank you. Thank you for having me on.
Yeah, absolutely. Now, I got to dig in. When I see Lehman Brothers, as would anybody, we all want to hear the story. So I'm definitely curious to know when you're looking at today's markets, especially credit and investor behavior, are there any patterns that feel familiar? Are there any signs that you've learned to watch more closely for this time around? I mean, that's an insane way to break in your career right out the
And,
gate.
and by the way, to start out, how did I get involved in real estate? So I grew
Yeah.
up in the hood, and my dad was a carpenter, and my mom ended up selling Fannie Mae foreclosures as a real estate agent, which was in the 90s in Boston. So for me, my first crisis was kind of my mom as a real estate broker selling Fannie Mae foreclosures, and I was the tall, skinny kid, crawling through basement windows to unlock vacant buildings, the front doors. And so that was my start into real estate, was in the middle of a real estate crisis. And my dad was then became from a carpenter, an architect, and he was laid off every time there was a recession. And he always said he was a leading indicator of a recession coming because you lay off architects because you don't need the design because you're not going to do any projects. And so when I joined Lehman coming out of business school in '06, so I'd done my summer internship there. I just give you an idea where my head was. I bought my first multifamily property out of college. I sold it in '06, and I sold it by telling the real estate broker. And if anybody knows, filings basement pricing. If you don't have an offer, drop the price, 5 to 10% every single week till we have an offer.
Wow.
But that was my view in kind of '06 of where our market was. And so I was at Lehman, kind of sitting there doing deals. And I was in the London office, so a little bit distance from the New York office, from the epicenter of it, but very much involved. It was it was a global team. I dealt with U.S. transactions, European transactions, and it was a very interesting time because it gets what people don't think about going into a crisis is that it gets white hot before it flames out,
Hmm.
and that's what we saw, right? So if you go back, and one of the most interesting things for people to do is everybody now looks in the rearview mirror and says, "Oh, it started in '06 and '07, and all the warning signs were there." Yeah, but if you went out there, like Bernanke was on there saying housing prices have never fallen across the nation. If that did, it would be a catastrophe, but it's never happened, right? And it's like,
Hmm.
well, like I don't know. And I think a lot of people were saying in the news and everywhere else, nope, can't happen here, right? No, of course, this time, just like you hear today, no, this time around is different. The banks are structured different. The economy is different. It's more diversified. We're more sophisticated. Our economy doesn't go through cycles and crises like that. No, we're too interconnected. And you heard all the reasons on why it couldn't happen. And so that sounds very familiar, right? And I'm kind of like I'm an economist at heart. That was, my master's was in
Hmm.
economics before I got my MBA. And it was always kind of like, you're predicting, like the Economist magazine, 9 out of every, one recession, right? So um, I've always thought a recession was coming well before it's coming, right? Like you're looking at the indicators. And so then it was looking at the indicators of what was happening in the housing market, looking at affordability, looking at prices and saying, wait a second, does this make sense? How does this make sense? how does this make sense that it's going up this high? How does it make sense that people are paying these yields with this financing cost? And then when you start having to do deals where everybody's forecasting growth because there has been growth, and I
Mm-hmm.
love it. Somebody now is looking at a deal and they said, "Hey, listen, my growth next year is going to be this." Well, why? Because my growth was last 2 years with growth of this. Well, that maybe that indicates that there's less growth available. Like that's the other way to look
Yeah.
at it, right?
Mm-hmm.
And so, I've always taken a conservative view, which is probably why I spend more time being a lender than an equity investor. But, at that time, it was crazy. It got white hot. One of the most interesting things that you can do as a real estate investor, right, is to go back and put yourself in the mindset at that time. Go look up Wall Street. And I did this a while back. I post fairly frequently on topics. And I wanted to get myself in the mindset of '07 and '08 because I wanted to make sure I wasn't remembering it in hindsight without really looking at the facts and the news you were seeing every day. And I
Mm-hmm.
looked up articles that were written on real estate from kind of '07 to '08. And I just read through for hours, read through articles that were appearing in newspapers. And everything was kind of like, hey, we've got some issues over here, but everything's fine. Like we're all
Mm-hmm.
okay. And you saw even articles in the New York Times about individuals queuing at open houses in 2008 to get into open houses. So you think about that.
Wow.
Like most of us consider that the crisis was already well known in 2008. And you
Mm-hmm.
had quotes from people that were queuing for open houses in 2008 saying, oh, but if I don't buy now, I'm never going to get in because prices have been going like this.
Mm-hmm.
And then boom, look what happened later in the year, right? So it's like the January articles are the most, January 2008 articles are the most interesting articles you'll find out there if you find a set. And I think that's interesting exercise for anybody that invests in real estate and thinks that they understand the cycle and they're going to spot it. And it's kind of, why did we set up RD Advisors and why are we on the lending side of the business? It's kind of that component of the experience. As we said, look, we think we're pretty good at underwriting investments. We're probably not good at judging when the cycle is, right? So if you ask me when the cycle would have turned in 2017, when we set up the business, we're like, we're 10 years out of the last cycle. We're probably 10 years, like it's going to happen fairly soon that we're going to head into a recession. Better get defensive, better get on the senior debt side, right? So we're on
Mm-hmm.
the senior debt side. We only do senior debt in our fund. And, we're in a single market that is judicial foreclosures, and we try to keep the LTVs fairly low.
Mm-hmm.
So we like to have 30 to 35% equity cushion in front of us on the valuations that we expect if it's a construction project on the back end or on a, true bridge on the, again, on the back end.
Mm-hmm.
So, that's the way we've been thinking about it. But yeah, going through Lehman was a bit nuts.
So, what similarities did you see then that you think we are seeing now?
It's always, I think there's a lot of liquidity in the market, right? I think
Mm-hmm.
people underestimate you hear a lot of people talk about how much equity there and values there in the market. Hey, there's tons of value there, right? Valuations, leverage. I think you're always looking at the last crisis and saying, but in the last crisis, this was the problem. And in this crisis, we don't have that problem, right?
Mm-hmm.
And I think people are forgetting that the crisis from last cycle isn't necessarily the crisis this cycle, right? And so, if you look at leading indicators, right? So if I look at leading indicators that would indicate that things are not all well, right? I think the market has a bifurcation, right? And if you look at credit card and auto data, so I tend to look at a lot of the credit data, delinquencies are spiking.
Mm-hmm.
Student housing is another place. I'm sorry, not student housing. Student loans, right? So if you look at
Mm-hmm.
those on the margins and you dig down, you say, oh, mortgage delinquencies are fine. They're not rising that much. Yes, but when you dive into the FHA mortgages, right? When you dive into the higher leverage mortgages, you start to see cracks and you start to go, wait a second. When you drill down and you say, well, what are the ones that are like, the canary in the coal mine? Like
Mm-hmm.
those places in the market don't feel as healthy, right? And then when you look at things, I mean, we've heard it, and I think you've heard it on this where people are, they have memes about it, but it's like, what is it? The taco securitizations or the burrito
Mm-hmm.
securitizations for Klarna. It's like, Like, are we really, are we really running out of product? And so we're starting to package together things that maybe shouldn't go in, buy now, pay later, package in securitizations. Like, I don't know if that's a great thing, right? And maybe
Mm-hmm.
that's a small segment of the market, but what it indicates to me is that there's so much liquidity in the market for the markets to absorb, that there's a lot of money going into things that they don't really understand. And
Mm-hmm.
maybe they understand it better than I do, and I'm wrong on this, but it just seems like I don't know if that's where I'd put my capital, right? It doesn't seem like that's a dead
Yeah.
instrument. And then when you look at the pricing out there, so those are things. I mean, I think affordability is a big issue, right? So, and one of the things I look at is you go, well, if a house sold for, was one price in 2020 and mortgage rates have risen, I don't know, it's 50%, and the
Mm-hmm.
house still sells for the same price, you're like, in theory, right? If we
Mm-hmm.
said, hey, mortgage rates are now permanently, 7%, right? Or 6%, right? And they're not going down. Then to meet the market on the same person buying the same house, well, you can afford 40% less. So in theory, if
Mm-hmm.
the rates had risen 7%, then houses should fall 40%, but they haven't. They've actually increased in Boston. I find the craziest thing looking at Boston
Yeah.
housing prices going, mortgage went up and prices went up. What? And it's, well,
Yeah.
everybody's locked in. You have this lock in effect.
Hmm. Speaking
And
of too, I wanted to dip my toe in the water about the Boston market. So, you pointed out that basically the greater Boston area is short by around 150,000 units and that new construction is basically slowing down very fast. So,
yeah,
with that kind of imbalance, what are you seeing as the strongest risk-adjusted returns out there? Is it traditional value add, multifamily deals? Are those still kind of the go-to, or is it more conversions starting to pick up like office to residential?
so I don't know. We don't yet know. This is a reality. On the office to residential, there's a lot of interest.
Mm-hmm.
There's also a lot of subsidies, right? Like Boston is a funny market. It's very hard to build. The reason people aren't building isn't because there's no demand. It's because, and in Boston, it's the greater Boston market. If anybody's from there, it's different than a normal city, right?
Mm-hmm.
City of Boston, when you talk about like the mayor of Boston, like there's only 800,000 inhabitants of the city of Boston, whereas like the greater Boston area is 5 million people. It's 100 different towns. And so
Mm-hmm.
100 different towns with 100 different rules on zoning and permitting and 100 different views, right? So Cambridge is going full on to build housing. Everett is
Mm-hmm.
building housing. City of Boston is going, you can build housing. We want you to build housing. But every time you build something, you got to add 20% affordability. And you go, wait a second. So for every, 5 units I build, one of those units has to be a loss making unit. That's
Mm-hmm.
20%. Well, if your builder margin is about 20% on your typical project, it means there's no profit to build.
Yeah.
So why aren't we building housing? Well, because I've got to take a loss in every unit on essentially every unit I build or every property. It doesn't make any sense. And so until they get rid of those rules, now in the suburbs they've kind of got rid of those, and development is happening, but it's still a very long process. And the
Mm-hmm.
zoning for the city is set up such that it's very hard to tear down a single family home in a large lot and build a multi. It's just not set up that way. There's a long bureaucratic process, and it's just means that you don't get a lot. And there's a lot of NIMBYism. Everybody goes, we want more housing, but next to you, not next to me.
Yep.
Right? And so when
Yep.
you have everybody going like this, it's not getting built. And so, you kind of go, well, what are you going to do? Well, are you going to invest in new development? It's very hard to build, very expensive to build. It's, I think if you have a great site and it's already permitted, maybe there's some value to build there, right?
Mm-hmm.
But a lot of what people are doing, and yields are relatively low in the greater Boston market, right? So if you want to buy core class A, like I think people today are expecting, they're still selling in the 5 caps. And I
Mm-hmm.
go, 5 cap when rates, I mean, maybe you're borrowing Fannie Freddie at 5.25, but like maybe less, I don't know, maybe there's something out there, but I'm like, it's counting on a lot of rent growth, and I don't know if
Yeah.
that rent growth is happening, right? Like people are
Mm-hmm.
kind of at the max. And so then you go, what are the real opportunities? Like, where do I see the opportunities? I think the opportunities in the greater Boston market in specific are going to be the recapitalizations. And I
Mm-hmm.
think you're hearing it in the news. There's this wall of maturities.
Yep.
And and I'm starting to see it in the Boston market. So before, there were no multifamilies on the market, and now and the small balance stuff, even the larger ones. I think the larger ones, there's still core fund capital for. So if somebody has, a 300 unit project, some core fund is snapping that up at a 5 cap, right? It's
Mm-hmm.
Class A core fund, and they have tons of capital that's flowing in from people's brokerages accounts or wherever it's flowing into, and they're not IRR focused, right?
Mm-hmm.
They're comparing it to a money market. But that stuff where, the buyers, you and I, personally buying those type of things, projects, that those kind of 3 unit to 20 unit projects are starting to sit on the market a little bit longer. There's more
Mm-hmm.
and more borrowers there, and I don't think it's the same as it would be in markets outside of the Northeast, right? We still have a fairly solid, stable rental market. There's no oversupply.
Mm-hmm.
But if you were at a 2.5% loan and it was 5 years and you did it in 2020 or 2021, guess
Mm-hmm.
what? It's in default. And if you go speak to Fannie Mae, Freddie Mac servicers for small balance loans, they will tell you, at a 7 cap, there's not, that at a 7% yield or even a 5 refinancing, all these things are in default. And so, then where's the opportunity? Well, the
Mm-hmm.
opportunity is, and this is, or the flip side is somebody has longer term debt and they're at a 2.5% rate and it's for long, but they can't get out of it. They're now at a 50, they did it at 70% leverage. Values have gone up. Now they're at a sub 50% rate.
Mm-hmm.
Where's the opportunity? The opportunity is in recapitalizations. And we're actually, and why do I know this? Because we spent a lot of time researching it, because we're a lender typically on the senior side.
Mm-hmm.
But what we're seeing is more and more requests. And we said, wait a second, we've had a bunch of these come in. We said, we don't have a fund. We only do senior debt, but you get enough requests for recapitalizations with mezz and preferred equity. And you're like, well, if I did something like that, given our senior is priced at 12, then my mezz is at 18 and nobody blinks, you're starting to think, maybe we should raise a fund for that. So we just launched, a small mezz and preferred equity fund just in case those opportunities keep popping up. But we think that's where, from the equity side, it's going to be those recapitalizations or potentially, when they go through foreclosure. I think, there's going to be some groups that are buying up some of these smaller deals around the country and packaging them up because they're going to get them
Mm-hmm.
at a discounted basis from where they, otherwise would have traded.
Yeah, absolutely. Interesting. And since we, focused on Boston, I want to shift over to New York because I can't recall his name, but it's this young up and coming political mover and shaker that has
Yeah,
a
yeah.
big socialist agenda, is at least what they're kind of portraying it as in the media. Do you recall his name by chance?
Tahani. Tahani, am I saying it right? I think. I don't know. Maybe
Yeah,
not.
hopefully
Uh,
everyone's following what we're talking about because what I'm curious to know is as a lender in New York,
but we're not. We
how
have done, so let me be clear. We have
yeah.
done we've done a few loans in New York.
Mm-hmm.
Our home market is the greater Boston area. We have an
Ah,
office in New York, but their office in New York we're a partnership between myself and a family office. And the family office sits in New York for the
ah.
moment, right? They're certainly thinking about, like where all these political things that are going on
Mm-hmm.
and taxes and all those sort of other elements. But so we've typically, our focus, 90% of our business is in the greater Boston area, kind of New England,
Yeah.
excluding Connecticut, right? So, and the reason is just as you allude to,
Mm-hmm.
it's judicial markets. So New York, you have to go through, if you want to foreclose, you talk about being a lender on it, it could be a 3-year process to foreclose. You can do a UCC and it's faster, but then if there's other liens behind you, it's a mess. Greater Boston, it's a non-judicial market, and this is anybody who's looking at, partnering up or doing lending. One of the most important factors is within the state, and Texas, non-judicial market, right? So you can
Mm-hmm.
start a foreclosure and it's 30, 60-day process to get to an auction. Boston, 30, 60 days to get to an auction. New York, 3 years. I don't want to lend in New York, right? It's not.
Yeah.
And then you go and you look. New York is complicated. I mean, do I want to deal with rent stabilized? Do I want to do, no, I just, and it's so much capital here.
Mm-hmm.
It's great to come to New York, raise money, finance, find financing partners, joint venture partners. The capital market flows in New York are second to none. No,
Mm-hmm.
no, nowhere I found better in the world. Even London, right? Doesn't compare to New York. Do I want to? But because of that, there's so much capital here, even though it's not the best place to lend. And so that's why kind of like Boston, it's like smaller, a little bit slower, local, kind of have a moat around the market. And we built an operating platform. We've been in the market 8 years.
Mm-hmm.
People don't like borrowers. I have a 917 number, so that's a New York number. Borrowers want to pick up a 617 number. They want to know that
Mm-hmm.
you're in Boston. And we have such a repeat borrower base in Boston. It is like you kind of build a moat around your market, and that's incredibly important, right?
Interesting.
But yeah, I'm watching the politics in New York. I'm sitting in New York. I'm speaking to people, and there's certainly an attitude, at least now. We'll see what happens. That people are like, why would I own here, right?
Mm-hmm.
And why would I keep my capital here?
Yeah.
And do I want to live in New York City? Maybe I have to do business in New York City, but maybe I live in New Jersey or Connecticut.
Mm-hmm.
Um, Maybe I move down to Miami and commute back here and make sure I spend less than, like, I don't know if it is like 130 days a year in Manhattan.
Yeah.
But
Yeah.
like the discussion is there, right? It hasn't happened yet, but I think the discussion is there going like, I don't know, like this is not good.
Yeah, I mean, well, you answered my question either way because I was going to ask, what kind of reservation you would have from a lending perspective, and that answered it plenty.
But
And I'm sure you're not
we were
alone.
already like this market is, no, we like our like market, non-judicial. We kind of have
Mm-hmm.
barriers to entry. I think it's very, Boston people are like, I don't know how to say it, but it's like a closed market. It feels like people in Boston want to deal with people from Boston.
Oh, yeah.
In New York, people constantly tell me, "Hey, we'd like to partner up with you because we've been trying to get into the Boston market for
Mm-hmm.
ages and we just can't break into it." I said,
Yep.
"Well, like I
Interesting.
like it like that."
Yeah.
Uh,
Yeah, no, for
uh,
sure. Now, just for the benefit of our listeners, I want to pull the lens back a little bit and kind of take a wider angle. So, first of all, this is very elementary, but I just want to make sure that we've got that out there, for everyone that's listening, because it's easy to get lost in the inside jargon and kind of leave people out of it. So, just very simplistically, can you explain basically what bridge lending is, why this product is utilized by general partners, and help investors, especially passive investors, understand that it can be structured in a way that actually favors the business plan and their overall returns versus the type of structure that works against them, just so that people really have a clear
yeah.
understanding about it.
So a couple of things. So, kind of what do we do and why do we do it, right?
Mm-hmm.
So we're a bridge lender. We do construction lending as well. So our typical rates or typical terms are we're lending at about 12% for 12-month terms. And then we have an extension on there for another 6 months. And that increases by effectively the interest rate increases by 3%. And you go, well, why does
Mm-hmm.
a borrower want to borrow that? And so then my loan sizes are anywhere from 500,000 to about 7 million today, right? And then what do we do with those loans on our side? Well, we're putting, that's in a fund with 60 to 100 of these loans in at any one time. Why do we do it as an investor? Well, it's incredibly secure to have, 60 to 100 senior debt positions, all of which have about 30 to 35% equity cushion on them, and they're all typically individual risk.
Mm-hmm.
So the point for our standpoint is it's a capital preservation and a yielding product, right? So, we set it up initially because we needed something that was beating where we were with treasuries in terms of returns, and then, but not as volatile as either the public or private equity markets, right? And so this
Mm-hmm.
was from my own personal pocket and then also from the family office perspective that we partnered up with. So we created it for our own capital, investing it. And then from the borrower standpoint, you go, well, why does a borrower need, a 12% loan?
Mm-hmm.
And you kind of go into it and you go, well, yeah, why would I borrow? Well, it's like, and I constantly go to my borrower and I go, well, why would you borrow from me if you can borrow from the banks at 5%? Our
Mm-hmm.
typical situations are bankable borrowers. So our credit scores are high 600s of our borrowers, right? So that's the average, right? Some are even in the 700s.
Mm-hmm.
The borrowers are using our non-bank lending. I've closed transactions as quick as 2 days. And so what does it allow our borrowers to do, right? So one use case is you're going to acquire a transaction and it's a multifamily transaction. And you're looking out there, it's a small balance transaction. You go to the owner and say, hey, I'd like to buy this, and here's my offer at $10 million, but it's subject to bank financing, and we're going to close in the standard 90 days. Or you go back to them, backed by us, and say, I'm going to buy it for $9 million and I'm closing next week.
Mm-hmm.
And they go and they look at it. And if they're under any pressure at all, they're going to go and, we're closing next week. We're going to be at the closing table. This is it. And so all of a sudden, then you have a buyer buying it for a million less than what the other bettors were competing with. It's on market, right? It's not even an off market transaction. And then they close it with the bridge loan. They're paying us a higher rate, but they might refinance. Typically they think they're going to refinance in 3 months. What actually happens is they said, well, while I'm at it, add some construction proceeds to it. I'm going to rehab a couple of units, and
Mm-hmm.
then I'm going to refinance it at a $12 million valuation, right? So I'm going to add some work at it, and that way I can not only take out the debt and all. So it's a speed factor that allows deals to get done, right? And
Mm-hmm.
you can even think in a competitive market, you just go with a $10 million bid and somebody else has the same bid, and you either get the deal done or you don't, right?
Mm-hmm.
So if you're an equity investor, I think you should be shooting for 20% returns, right? If you can get 12, 10 to percent kind of in senior debt, then if you're getting that in senior debt, then on your equity side, you should be getting like a heck of a lot more, right? Because there's more volatility and more risk. And so if somebody's underwriting deals at a 20% return and paying 12% for the debt for a short period of time before they refinance at a 5%, that's why you do a bridge loan. It's speed and execution, getting a deal done, and actually capturing a deal that you otherwise wouldn't have earned that 20% on, right?
Mm-hmm.
So that's kind of one use case. Another is it's construction on the smaller balance side. It's just difficult dealing with banks, right? Even I have bank loans now, and like I have to send all of my financials over for a deal that I'm like, why do you want every single LLC that has nothing to do this? Send it over every single year. You want my tax returns? I mean, this deal is cash flowing. You're at your
Mm-hmm.
50% LTV, and the bank's like, nope, I need it for my records, and you're like, And so some people just don't want to deal with the bank. So if the transaction is only a 12-month, turnaround, I
Mm-hmm.
just say, oh, pain. This is just so much simpler. And
Mm-hmm.
you know, when you do banks today, I think if you're doing construction lending, we're probably at a 12. Banks today in Boston might be at 9, 10. And then
Mm-hmm.
they've got prepayment penalties. And the other thing is, if
Mm-hmm.
you've got a short timeline, I don't have a prepayment penalty, right? If somebody wants to borrow from me, I'm going, you know what? If you want to pay me back in 1 month, pay me back. You go to a bank and they've got a 5, 4, 3, 2, 1, right? So you borrow at 7, you pay back in the first year, you've got to pay a 5% prepayment penalty after they've just gone through I don't know, a 60-day closing process that was kind of painful. And so
Mm-hmm.
that's why there's the need for the non-bank lending. It's a much faster, right? So I'm a real estate owner and developer myself. I get it from the investor side, right? So
Mm-hmm.
we understand it. We're single market sharpshooters. We don't need tons and tons of time. And we do parallel processing. We do the same underwriting a bank does, but I don't know why the bank has to wait for certain components in for them to get the appraisal started, right? Let's go do it all at once in a short period of time, right?
Mm-hmm.
And focus on efficiencies, build the systems out so we can do it. So anyway, so that's why the need from the borrower is there. It's really the need for speed and the need for doing stuff that's more creative and less kind of, like you don't feel like somebody's putting on the rubber gloves when you're getting a loan, right? So we still
Mm-hmm.
do a credit check, background check, and all those things, but I don't need to see your 2001 taxes for every single LLC that you have. It's just I'm not irrelevant, right? To this transaction.
Yeah, yeah. And so, interesting because I'm curious to know you've gone from, executing multi-billion dollar deals to institutional financing, and now you're over here originating deals as low as 500,000. So I'm
Yeah.
just curious to know how that shift has worked for you from going to Wall Street to basically your everyday, average person here. Have there been any surprises, either like
Yeah.
structurally or culturally, that you've adjusted, between these two shifts?
Of course, you go from like we had Whitehall as a client at Lehman, Whitehall, which is Goldman Sachs,
Mm-hmm.
Morgan Stanley's fund, Tishman Speyer, and I was interacting Steve Witkoff, right? He's a developer that was a client. So you go and you have these big names, sophisticated groups. You have lawyers on both sides, and there's so many advisors that you kind of quarterbacking everything, but everybody's a professional.
Mm-hmm.
And I think when you go down to the smaller deal size, and we found that we don't really want to go much. There's a lot. I mean, this is why we're lending in Boston and not. We looked at some other markets, but they have $100,000 transactions. I don't want to do that. Like it's way
Mm-hmm.
too small. But a couple of things is you have to set up. You go from being a tailor to Zara. You want to make sure that you have a template and you have a box, and it
Mm-hmm.
either fits the box or it doesn't. But you can't spend loads of time. Like my docs are non-negotiable. Everybody,
Mm-hmm.
we used to spend hours at whatever firm it was, private equity firm, going back and forth to docs.
Mm-hmm.
Now, here's my docs. They're form docs. They have everything up. They're 200 pages. We have to close in 10 days.
Mm-hmm.
They're non-negotiable. You can read them, you can review them, your lawyer can look at them, you can make sure that there's no mistakes, you can make sure the name's spelled right, you want to check everything, but there's no negotiation.
Mm-hmm.
It is what it is, right? So you have to build a business that scales across doing many transactions, and you have to build it in a way, and then you have to focus. You can't, and people think about this, they're going, I can't understand why people invest with national lenders that do small scale deals. There's no way I can understand and underwrite a loan in California. What am I going to take a week to get to know the California market and study it? No. If a deal comes in and day one you can't analyze it and figure out because you know the market that well and you have a team that knows the market that well, don't do the deal. Right?
Mm-hmm.
Whereas when you were doing massive deals, we're in London, but we do a deal in Paris. We've got all the sorts of experts. We've got partners on it. We've got a Paris team. We're going down there. We're flying there. We're surveying the market. We do it. Maybe we didn't know the Paris market as well as we thought, but now you have to be hyper focused on doing what you know very well. And then you have to have the ability to kind of take them over, right? You have to understand it. No, we don't do that very often, but you've got to understand at that level. And so that's one big difference in it. Another big difference that people don't recognize is when you're doing billion-dollar transactions, your originations is pretty easy, right? So if somebody's financing a billion-dollar transaction, your list of like people that can finance that transaction, and by the way, or the number of people doing billion-dollar transactions. If you're a bank and you need to figure out who's doing a billion-dollar transactions, there are 50 guys, 100 people, right? You're going to know them. You're meeting them all at the same conferences. Somebody in your 100-person office knows somebody at that firm.
Mm-hmm.
They exist. Okay, now we're going to go into a place where you're doing $500,000 to $7 million transactions. I think in Massachusetts, you've probably got about a couple thousand potential borrowers, and now you realize that all of a sudden they don't know who you are. You have no way. You're not going to meet them all on the street. So then all of a sudden, you go from being in a B2B business where sales and marketing don't matter because you have the capital, they'll find you. They have the deals, you'll find them. It's a small universe. To this much larger universe
Mm-hmm.
where, and I just did a post on this, I think today or yesterday, but you've got to go to be a B2C business. All of a
Mm-hmm.
sudden, you have to think about branding and marketing and origination strategy. And one thing, our firm, compared to most lenders, we don't have any originators. You go, how do you bring in deals when you have originators?
Yeah.
Yeah, 8 years. I
Mm-hmm.
don't want Coca-Cola doesn't do door-to-door sales, right? We want to be a brand. If you are a bankable borrower with a non-bankable transaction and you are looking for a sophisticated partner on the financing side that is not a bank, that's us.
Mm-hmm.
But that means we have to get the word out there. So all of a sudden I found myself talking about social media strategy. Like, I'm a guy who skipped my marketing classes in business. Like, I don't know why I need this. Like, I great at Excel. I'm going to do financing and understand the cap stack and structuring and, taxes. But I certainly don't need marketing. And we've got a
Mm-hmm.
whole marketing team, right, that does that. Like,
Mm-hmm.
now all of a sudden I find myself doing marketing, right? And
Mm-hmm.
never had to do marketing before. Certainly never had to do capital raising, right? So you
Mm-hmm.
go talk about it and you go, well, how do investors find you? I don't know. Like, right? Like, it's like learning all these things that, like, by the way, did you tell that person that you had a fund that was on, it was a 506C and they could invest? No, I forgot. I don't know. But so you have to get really good at realizing that you've got to get into marketing and branding and build a brand. And we've been
Mm-hmm.
very focused for the past couple of years on building a brand so that everybody knows, because you find a borrower, they don't have a transaction that day.
Mm-hmm.
You have to constantly be out there. And so that's why, you know, LinkedIn, I'm out there, right? People know that I exist. You know, Instagram, why have an Instagram page? Guys that are fixing and flipping homes or even on, buying multifamily properties, a lot of them are Instagrams showcasing their projects, right?
Mm-hmm.
Um, they're going to find us through there. We have a feed. We have 2,500 followers in the greater Boston area, right? So
Mm-hmm.
people underestimate the value of that sourcing channel. So how
Mm-hmm.
are you going to replicate? I've probably got probably 4,000 followers in the real estate industry on my LinkedIn. That's just
Mm-hmm.
in Boston, right? And so somebody else wants to come in and compete with us. They don't have that sourcing channel. They,
Mm-hmm.
they can't. They don't have that reputation. We have 8 years. We've funded nearly 400 transactions. People see our name on the deal rolls and like, oh, you funded this transaction. So figuring out that you're a B2C business as opposed to a B2B business was a huge learning curve for me. Like, I just like the first couple of years, I just couldn't get it in my head. Luckily,
Mm-hmm.
we're 8 years into it. We figured it out, and I think we're pretty good at it now. But that was a huge change.
Very interesting. And speaking of changes, and this is my last question for you before we jump into what I call the lightning round. So Jamie Dimon came out recently making a statement about, private lending and how it really made him very nervous because he thought it was reminiscent of, kind of other factors that were similar at the time in the market before the GFC. But at the same time, all the big boys are wanting to get into the game too because they do see the demand. So I want to know from your perspective, where do you think short-term bridge lending is headed now into next year, especially in terms of risk-adjusted returns? And if the benchmark rates start to fall, how do you see lenders managing their own cost of capital?
Yeah. So that's a big question, right?
Yes.
And so I think a lot of things that get put on the Wall Street Journal or the news or Bloomberg, they go private credit. And
Mm-hmm.
so private credit, you go, well, that's everything from your, burrito securitizations that are buy now, pay later, right?
Mm-hmm.
And
Terrible
that's
idea.
one end of it, right? Or private credit could also be financing a startup tech company with zero revenues with, pay in kind loans, i.e., they're just accruing, there's no current payment, right?
Mm-hmm.
It could be a second mezz on a building that is underwater, right?
Mm-hmm.
That's all private credit. So, and then there's also the realm of the private credit where we sit, which is senior secured on real estate, current pay, stuff that is relatively lower LTV and, with very little debt behind it. And so those two things are both private credit. And so I
Mm-hmm.
think this massive, $1 trillion private credit world, when Jamie Dimon's talking about it, he's talking about this corporate financing world. If you
Mm-hmm.
then went and asked in specific about, well, what do you think about senior secured real estate, loans that just happen to be done by non-banks, like you want to talk about your loan book, Jamie Dimon, like, I think it would be a different view. I think you really need to
Mm-hmm.
segment it. I think it's getting a broad brush, and I think
Mm-hmm.
people need to segment it. And I think we're focused on the senior secured side. For us, if rates fall, I think it's great. I think we're still going to be able to put out capital at the 12% rates because it's the scarcity of capital. And this is one of the things you talk about, the Lehman learnings. After Lehman, right, in the GFC, nobody's asking about the cost of a life raft in a storm.
Mm-hmm. Yep.
If capital flows, right? So it's not the cost of capital that matters, it's the availability, right? And
Mm-hmm.
so if rates start falling, it's because we're heading into a recession. If we're heading into a recession, capital pulls back. So if you have capital at a time when capital is scarce, you can charge what you want for it, right? And
Mm-hmm.
so that's what we're planning to be in, is in the environment. But our leverage on the back end is SOFR based, so it falls. So our spreads widen. So we'll have a higher spread and we'll actually earn more if rates fall and we head into a recession, right?
Mm-hmm.
That's my gut sense, right? Just having gone through it before, right? And our returns have been pretty steady. Like, we're getting 9 to 10% returns almost, every single, annualized almost every single year for 8 years. But that's what we do, right? That's what we do day in and day out. And so, what's going to happen to in a recession to stuff that, and what Jamie Dimon is probably alluding to is what you're talking about is covenant light. So
Mm-hmm.
I'm senior secured. I have a UCC. I can foreclose on the property. I can foreclose on the LLC and have a personal guarantee. Covenant light is when somebody's doing a loan, they're probably not senior, they have very little security, and it's just a hope that somebody's going to repay them as long as the economy keeps going well.
Mm-hmm.
Well, when the economy doesn't do well, they're probably not getting their money back there, right? And so I
Mm-hmm.
think that's where the real worry is on that stuff that is the covenant light. And guess what? All the major firms, when you go into it, they go, well, your side is the great side where you're senior secured doing smaller loans. Why don't all these massive firms with billions in dollars go into this? Okay, what you alluded to before. How are you going to find how many thousands and millions of borrowers do you need
Mm-hmm.
that are doing bridge loans in the construction space that you can underwrite from the huge tower in New York across America, like to fill this bucket? And by the
Mm-hmm.
way, then you've got barriers to entries. You've got to find several thousand borrowers. You've got to underwrite them. It's just hard. They can't enter into
Mm-hmm.
this market. So then all the billion-dollar firms are crowded in this space where there's billion-dollar loans, which are on private equity, corporate stuff. So,
Mm-hmm.
I think that's what he's alluding to. And I think his frustration is that he's got to compete with a whole bunch of other firms that have raised tons and tons of money. And they're telling their clients, well, you know what? We're not going to put that covenant in there, right? We don't need
Mm-hmm.
to be senior secured. And he's got to play in that market because he's got to put the money out. So
Yep. Yep.
I think one thing to put in there that I think people are not watching, that I think is a very scary part in this market, that is different than last market, but could be a downfall in this market. One. So people are
Mm-hmm.
looking at the multifamily delinquencies. People are looking at the office delinquencies. What people are not thinking about as much, and I don't see any much news written on it, is the problem of it's great that homeowners have a 30-year mortgage for 2.5%,
Mm-hmm.
but somebody owns a mortgage for the next 30 years where they're earning 2.5%, and their borrowing costs are now 5%
Yep.
plus. And
Mm-hmm.
so in the debt business, that's called a duration risk. And what that means is if you do a mark to market, so if you said, hey, somebody was going to have to buy that loan that's got another 25 years on it at 2.5%, what is it worth today given today's rates? It's probably worth 40% of what it is.
Mm-hmm.
So even though nobody defaulted, you'd pray. If you have a 2.5, if you own a mortgage and you're a bank at 2.5%, you're halfway praying that it goes into default because
Mm-hmm.
you'd rather recover 70 cents on the dollar than have 50 cents on the dollar. That yield. So I'm wondering, those holders of the mortgages, how much longer can they hold out before they have real issues? Because if you're a bank and you're only earning 2.5%,
Mm-hmm.
and you're paying depositors, what? I mean, if people look at the deposits, and there's banks that aren't paying the deposits, but consumers are getting smart and they're going, hey, but I need to get 4.5% here. I
Mm-hmm.
think that's a real issue. And I think it's going to be a real issue when banks go bust about how bad it is, because only when banks go bust do they have to recognize those losses because they're not for the for sale product. And that's going to be very akin to, was it SVB
Mm-hmm.
when it went, Silicon Valley Bank when it went bust, right? It went bust not because it had senior secure mortgage, not because it went default, but because they were earning too little on the portfolio they held, and it just wasn't
Mm-hmm.
sustainable. And I think that's a big problem that is not being written about, isn't being investigated, but the mark-to-market losses on the $1 trillion mortgage market could potentially be massive. And I think that's something that's being overlooked by a lot. And that's why we prefer the shorter duration, 12% yield loans. But
Wow, fascinating insight. I'll have to have you back on so we can unpack all of that because
yeah,
that's a whole other fascinating conversation that we can have. Definitely insightful. But in the interest of time, we do have to get to the lightning round questions, which are
all
just
right.
5 questions that I ask all the guests on the show. So, are you ready?
Um, we'll see. We'll find out.
All
Let's go.
right. So, when you're not fast and furiously originating loans, what do you actually do for fun?
What do I do for fun? Sports, so kind of like fairly athletic. I have an 8-year-old daughter. So, we do rock climbing together. We hang out together to spend up a lot of time with her. So a lot of family time. If not, then some sports, working out, running, bouldering,
Yeah.
those sort of things.
Very cool. All right. And what is something interesting about you that most people don't know?
Hmm. I would say one thing about me is I grew up in the hood. So,
Hmm.
people come across me now, they would never realize I grew up in a Puerto Rican Dominican hood in
Wow.
Boston. So that's, and I came out of there and then ended up going to BU and then business school. So a long way from home. But
Yeah.
uh,
A success story, though. A very good one. All right, good. What about as far as podcasts or books? If people want to get a little bit more savvy when it comes to understanding, lending structures, debt, anything along those lines, is there anything that you'd recommend people should check out?
trying to think of what are good books. I always liked Michael Lewis's, like Liar's Poker. I always thought that was great. What else did he have? I think he has some good books that he breaks it down fairly well.
Okay.
Um, I think your podcast is doing great. You're asking some very insightful questions, and you're forcing me to break it down to terms that that are easier to digest. I guess I would say.
Yeah, yeah, for sure. Well,
Um,
and thank you for that. Yeah.
yeah.
All right. And then, one of the things that we also like to talk about on the show is, yeah, we all want to make money. We want to have good returns. But the point is not about the money. The point is we want to try to build and live extraordinary lives, right? It's a critical tool for us to be able to do that. So what is your advice for somebody who's focused on living an extraordinary life?
Oh, I always said people, in Wall Street, they always say something like, what's your number, right? Like, what is that number that you can make
Hmm.
before you retire? And I always
Hmm.
said, oh, no, no, no. I don't have a number. I have a place. So today, early in my career, it was like Guatemala, right? Like at this point in time, I could drop everything and go live in Guatemala and never work again, right? And so I think about it as where do I work up to, right? So,
Hmm.
can you drop everything, never work again, and live a good upper middle class life in New York City? Well, okay, well then you're doing all right. But I think also beyond it is passive investing, right? You have to earn a little bit more. You have to focus on saving and put some money. You can't spend every single dollar. You've got to
Hmm.
save some, right? Don't bite it down to the skinny where you're living a horrible life, but being able to, I mean, I started my own firm 8 years ago, right? And so, we talk about retirement. I don't want to retire. This is my
Hmm.
retirement. I keep thinking about what would I do if I retired? I'd get bored on a beach after 2 days. I'd write a business plan. I'd call up a good friend and I'd say, hey, listen, I've got something. Let's start it. This is going to be fun, right? And
Yep.
basically, that's exactly what we had. We founded RD Advisors. It was me and a friend. It was a family office I'd known for, now nearly 20 years. We sat down, sketched it out over brunch, what we wanted to do. We went into it, and we're very focused on working, but living life too. We do, we tend to do one thing we were doing is a lot of events for teamwork. So the rest of the team, I'm heading off to Europe. The rest of the team is heading up to Maine to do a triathlon. So
Oh,
everybody's
nice.
going to Maine together around a triathlon. In the winter, we go do the Miami marathons. Half of us do the half marathon or the 5K, but we all do a team event down there. So the team, but we want to love what we do as
Hmm.
opposed to focus so much on having to retire because you hate what you do today. Love what you
Yeah.
do today. Put some aside so that you never feel trapped, right? You never want to feel trapped because of something fails. It allows you to the flexibility to do a startup. But that comes with having some stuff and some passive investments that you set aside and just continuing to work through it.
Yeah, very nice. I like it. All right. And then, Sean, last but not least, if folks want to get in touch with you, how can they find you?
So a couple of ways. So We're, RD Advisors. You can look us up on a number of different platforms. It's Sean Kelly Rand. The easiest way to find me is on LinkedIn. And then we have our website, which is rdadvisorsre.com. And so people can find us there. We have information on our firm and our funds. But hit me up on LinkedIn, follow me there, and you can always DM me, and I'm pretty sure I'll give you a response. And look forward to hearing from you.
All right, very good. Well, thank you for a very interesting and insightful conversation. Really appreciate your insights. Very cool. We will definitely have to have you back.
Thank you very much. It's been an absolute pleasure being on the show.
Yeah, for sure. And for those of you that invested your time with us today, thank you. Don't forget to leave us some comments. Let me know what else you want me to dig into. And in the meantime, be bold, be extraordinary, and keep moving forward. Ready to Scale is brought to you by Blue Lake Capital, where we hunt down the best multifamily investment opportunities that we can find and invite investors to join in with us. We target Class B value-add multifamily properties across the Sun Belt. Our CEO, Ellie Perlman, invests a substantial amount of capital into every deal. This means our interests are aligned with yours. If you're an accredited investor looking to expand your portfolio and diversify sponsors, be sure to visit us at bluelake-capital.com. Blue Lake Capital. Be bold, be extraordinary, and keep moving forward.